Good afternoon, everybody. Lovely to see you all. Can't see you all, but lovely to see you all. We'll give it a couple of minutes just to see if there's any more people who are still joining us, and then we'll make a start. Right, 11 o'clock has now ticked over, so I will make a start. Thank you all for joining us today for this first in a series of webinars about residency that we are holding here at Gravita. My name is Michaela Lamb. I am one of the tax partners here, private client tax advisor, and I great pleasure joining you all today. Before we get started on today's webinar, which is about leaving the UK, just a few dates for your diary of the upcoming webinars in this series. So on the 8th of July, we'll be covering arriving in the UK with the practical considerations for living and working in the UK. On that day, I will be joined by my colleague, Rebecca Amy, our head of payroll, and my good friend, Victoria Welsh, who is partner and head of business immigration at Taylor Rose. And we'll be looking at the different side of things, people who actually want to come to the UK. If you are signed up for that one, there will also be some bonus content that will be sent around as a video only, which is coming back to the UK, which is becoming ever more popular given the state of the world at the moment. So please do sign up for that. If you don't have the link, it will be on the follow-up email, and it will also be on our website. We will also be doing the third and final part of the series, which is doing business in the UK, getting it right. And that will be presented by my colleagues, Ben Chernoff, Claire Bowden and Tandy Cochran, all of whom you've probably seen before, of our fantastic presenters. So without further ado, I shall make a start. One last thing, actually, there will be coming around a poll at the end. So if you would like direct contact, that will be coming around at the end. So please look out for that. So today's agenda, we're going to look at the common residency myths and misunderstandings. Then we'll go through understanding how the statutory residency test works. Then we're going to look at how you qualify for split year treatment, which is important depending on what time of year you're leaving the country. We're also going to chat about treaty residency and how you can use that if split year doesn't really work for you and if the statutory residency test isn't going to work. And then we'll be looking at some continued UK tax liabilities and double taxation issues. I'm then going to do a brief look at selling a business before or after you leave the UK. Now, this has been a question I get a lot of the time, so I thought we'd just cover that off. We'll also look at the risks of temporary non-residency, so the anti-avoidance provisions, and then I'll briefly cover UK inheritance tax for non-residents, assuming we get time. Hopefully we will. So, okay, so common myths, the things I hear most when I'm dealing with people and their residency in the UK. I'm not legally resident in the UK, so how can I be tax resident here? Well, that is one of probably the biggest misconception. Legal and tax residency are not the same. It is perfectly possible to be legally resident in the UK but not tax resident, or not legally resident here but still tax resident. They are different. So that is one thing to be careful of. Don't assume that just because you do not have legal tax residency status here that you are not tax resident. The next myth that we get quite a lot of is that I've obtained legal or tax residency status in another country, so I must have lost my UK tax resident status. The most common one I'm getting at the moment is people coming to me and telling me that they have acquired tax residency status in the UAE, so Dubai. Lots of people going to Dubai at the moment. Don't blame them. The weather is much nicer. But just because you're resident in Dubai or wherever, it does not mean you have lost your UK tax resident status. Most countries will have different rules on what makes you tax resident, and therefore it is perfectly possible to be tax resident in several countries at the same time. Now, if that happens, we have to consider the double tax treaty to try and work out which country gets primary taxing rights. However, if you're becoming non-resident for inheritance tax purposes, for example, if you are tax resident here, even if you are not treaty resident here, you will still have to worry about the usual UK rules. So it's very, very important if you are going to leave the UK, you take what steps you need to take to become non-resident here rather than simply resident somewhere else. Third and final myth, which is again very common, is that people believe that if they spend less than 90 days or had 180 days, someone told me once, if you spend less than that in the UK, then you're automatically not tax resident. Unfortunately, that's not true. It may have been true in the past, or at least it could have been true in the past, and even now it might be true, but there is no guarantee that simply spending less than 90 days in the UK will make you non-tax resident. We need to look at a much, much wider field of circumstances to establish whether or not you have lost your UK tax resident status. Now, these days it is established, your residency is established by the Statutory Residency Test, which was introduced in 2013, and which we are going to look at in a lot of detail this morning. Subject to that, how long you can spend in the UK will depend on your circumstances, and it could be as little as 15 days, depending on what you've been doing in the past and what you've got going on in the UK. Now, as I mentioned before, then we could potentially use a treaty to get you outside of the UK tax net, but it doesn't work for all taxes. So, Statutory Residency Test. As I said before, this was introduced in April 2013, with the idea being that it gave people a lot more certainty over whether or not they were UK tax resident or not. Those of you on the call who are old enough to remember the cases like Gaines Cooper, there were different rules back in the past, and there were a lot of confusion and a lot of arguments over it. And the whole point of introducing the Statutory Residency Test was to give people clarity and certainty, which to a certain extent it now does. Now, the test is a three-part test, and the test kind of has to be carried out. Each section has to be looked at in order. And if at any point you pass part of the test that says, actually, yes, we've got a determination, you were either non-resident or resident at that stage, you stop the test. So either it's very, very quick to go through, or you need to carry on all the way down to the third part of the test, which is the sufficient ties test. Interestingly, it's the third part of the test, the sufficient ties test, that people seem to have grasped in the kind of like the public consciousness. Most people understand, or at least get an idea of what that is, but you have to go quite a long way to get there before you can say, I'm going to use that and work out how many days I can have based on my ties to the UK. So the test needs to be applied every year, and each individual that we're looking at talking to has to apply it themselves, so that you can determine what's going on for that particular year. But what you need to be mindful of is that previous year's behaviours and where you've been can affect a future year. So it is, while it's every year you need to look at this in isolation, you will still need to potentially think about the previous 1, 2, or even longer before years. When I'm talking throughout this, though, please also bear in mind that if I say a day, what I mean is a midnight. So if you are here during the day, but you leave before midnight, that day will not be counted for most purposes. Now, there are some cases where it can be counted, which I'll talk about later. But generally, if I say that you're there for the day, I mean you are still there at midnight. So if you sleep in this country, that's your day counted. Effectively, departure days don't count. So let's have a look. The first part of the test determines whether or not you are automatically non-resident. So very kindly, we start with the best case scenario for those of you who want to leave the UK, trying to work out if we can make you automatically non-resident. Now, there are 3 times where this might happen. The first is that you were not resident in the UK throughout all of the previous 3 years, and you've only been in the UK for 46 days. At that point, automatically non-resident, easy, self-explanatory. The second looks at whether or not you were resident in any one of the previous 3 years, so just one in the previous 3 tax years, and you've been present in the UK for fewer than 16 days in the current year. Again, clear cut, very clear to understand what that is, but it's quite restrictive. So for those of you who want to leave the UK but to still spend some time here, you're unlikely to want to use that test because there are other ways of making yourself non-resident if you fail that. The third test, which is the most common for the sort of clients I've been working with over the last few years, is for somebody who leaves the UK to work full-time abroad, and they've been in the UK for less than 91 days during the tax year and less than 31 days working here. So in this particular case, yes, 90 days is the number you need to be looking at, but you can only qualify under this part of the test if you are working full-time abroad, and you work in the UK for less than 31 days during that tax year. Now, working full-time abroad is very broadly 35 hours a week on average, but there is a very complicated and convoluted set of calculations that HMRC use to get you there, and it can sometimes have surprising results. So, for example, if you're working part-time, well, clearly you're working part-time, you're not going to get it. But if you're working odd hours and you don't always work 35 hours a week, or you go maternity leave or paternity leave or something, or you are taking leave for some reason, then it may not work for you. So you have to be very, very careful to understand what that means and to check. But assuming you can qualify, then this is usually, for an employee, someone who's going to work outside the UK, usually the easiest way and the simplest way to make yourself non-resident is just to make sure you are restricting how long you're in the UK. It's 90 days or less, and then fewer than 31 days working in the UK. Now, for this purpose, working in the UK means you are doing 3 or more hours work, and that can include traveling time. So to pinch a joke from one of my colleagues, the idea of working for 3 hours, that gives you a very good clue as to what HMRC think a working day looks like. For most of us, of course, it'd be more than that. But if you're anything like me, it might be a Sunday and I'm poking at emails and I can easily lose 3 hours. And that would be counted as a working day. So even a weekend, if you are messing around with emails or you get lost in a fog of phone calls, you can get caught very easily by this. Now, one of the things my clients say to us, how's HMRC ever going to know? Now, we all live our lives digitally. We know that. So it's not difficult to prove where you are and what you're doing. And even if you don't, we operate a self-assessment tax regime in the UK. And if you lie on that, we call that fraud. So you need to keep proper records and to make sure you are playing by the rules, because the last thing you want is an inquiry, especially an inquiry that involves residency, because the penalties on those are quite nasty. So if you've not managed to pass any of the tests, but you still want to make yourself non-resident, I'm going to change my slide. My slide actually says automatically non-resident. Please ignore this. When you get the slides, I'll have updated this. But this is the automatically resident test. Now, if you have managed to not get any of the tests for being non-resident, you then have to carry on to see whether or not you are automatically resident. The idea for you, those of you who want to leave the UK, is to not meet any of these. So the first one is that you need to avoid being in the UK for 182 days in the current tax year. That one, presumably you have control over if you want to do it. So it's self-explanatory, you should be able to do that. The next is about having all of your homes located in the UK. Now, it's not quite as simple as that makes out, but the idea is, as long as you have got other homes outside the UK, so you've rented somewhere that is available to you to use overseas, then you will have a home outside the UK and you will not fail that one. Now, you need to make sure that if you have got a property overseas, you do spend at least 30 days there. And then you need to make sure that you are spending time there, and there's a sense of permanence to it. A home is not just somewhere that you've rented and don't use. Airbnb is unlikely to count unless you've got it on a long-term basis. You need to have some form of permanence, but you can keep your home in the UK as long as you have got some other form overseas. The next and final test, which is the one that catches people out, is working full-time in the UK. The reason this catches people out is that it runs on a 365-day rolling period. And we look at whether or not you were in the UK or you were working in the UK for 75% of the time. Now, when you initially go overseas, if you have been working full-time in the UK prior to your departure, chances are you're going to be caught by that test. So you have to be a little bit careful. There are ways around it, because one of the other conditions that you need to take a break from UK employment. Now, if you take a break from UK employment, you may be able to break the 365-day cycle, but it is really important that you look at that one and understand what it means, rather than just assuming that because you've ceased working in the UK, you are no longer working in the UK. If you manage to avoid catching any one of those, you can then move on to the final part of the test, which is the sufficient ties test. Put my teeth back in. And this is, as I say, this is the famous thing. This is the thing that everybody seems to have connected to and understand what it means. Now, we have to think about people as arrivers and leavers. If you've been living in the UK, you're going to be a leaver. If you've not come to the UK, you're going to be an arriver. We're going to assume for today's presentation that you're all leavers, because we'll look at arrivers next week. So looking at leavers, we're looking at the conditions that sit on the right-hand side of the stage. Now, what we have to do is to combine the number of ties you have to the UK and then match that to the amount of time you're in the UK. Now, this is a backwards looking test as a rule, but you can use it for planning if you are prepared to be flexible about things rather than get to the end of the year and then work it out. The whole point of this is to be able to say, well, these are the ties I know I've got. So this is how many days that I can spend here. Or to say, okay, I can reduce my ties because I know I want to spend this much time in the UK. Now, as a leaver, there are 5 ties that you might have. One is the UK resident family, one is accommodation, one is employment, one is spending 90 days or more, and then the last one is spending as many or more days in the UK as any other single country. Now that disappears after time, so that final test does disappear when you've been out of the country for more than 3 years. So that means from year 4 there may be a bit more flexibility because at that point you become an arriver. But as I say, we'll look at that. We'll look at that later. So what can we say about these ties? The 90-day ties is pretty self-explanatory, and most people will have this tie. Most people leaving the UK will have this tie for at least their first 2 tax years. They may have it in year 3, 4 and onwards, depending on what's going on. And this is what I was saying about before, that the test also considers previous years. So while you need to do the test every year, you will need to consider at least the 2 earlier years in order to find out whether or not you've got this tie. So most people have this tie when they first leave the UK. The family tie comes next. Now, this one relates to a spouse or a civil partner, someone you have been living with as your spouse, a child under 18, and then there are some complicated rules when you have got children who are being educated in the UK. So if you are not moving overseas as a family and you are leaving your significant other back in the UK, or you have got children who are staying here to be educated, you could pick this tie up. Now with education, if they are not staying in school outside of school holidays and they are coming to you for school holidays, for example, you may not suffer that type, but you just need to be careful of that. It can be complicated though, of course, if you're divorced, for example, and you have got children who are living with your significant other in the UK and they are under the age of 18, that can sometimes catch you. So you need to be careful with this tie. The accommodation tie, again, is slightly more nuanced than it sounds, because if you keep your own home, as many people do if they want to come back and visit, and that home is not rented out, so it is available for your use, you will have this tie. You can also pick up this tie if you have got somewhere to stay with a family member and you use that place for more than 16 nights a year. During the tax year, that is. So if there's somewhere else you can use, or you've got rented accommodation here, or if you have perhaps got a contract with a hotel that you can use for extended periods of time, you may have a room booked out with a hotel or an Airbnb or something like that, where you know you can use it for an extended period of time. As and when you need it, you leave your stuff there. That can potentially, again, give you the accommodation time. Substantive employment tie includes self-employment. So if you are employed, self-employed, or even unpaid work, I've seen the arguments over whether or not voluntary work can count as well. So you just need to be a bit careful about it. But if you are working in the UK for more than 40 days, then you will have this tie. Now, again, this is a 3-hour test that we're looking at before. Working is drawn very, very widely for this. The interesting thing is, of course, this gives you an extra 10 days to what you could have had if you had gone for the 90 days and the 30 working days under the initial test for being automatically non-resident. So if you need a bit more flexibility and you've managed to get yourself out of being automatically resident here, then this can give you a little bit more flexibility. The final tie is the country tie, which I say only applies in your first 3 years. The first 3 years that you after you become non-resident, and it's about spending more time in the UK, or as much time in the UK as any other individual country. Now, all being well, the idea of leaving the UK is that you found a country that you'd rather spend time in. But if you're going down the nomadic route and you are traveling around a lot and you are spending time in the UK but not necessarily fixing yourself somewhere else, you can end up picking this tie up. So it's one to be careful of. So once you've gone through all of the tests, you will get to a point and work out how many days you've been in the UK versus what ties you've got, and hopefully, I'll go back. this quickly. You should be able to make yourself non-resident. So, for example, let's say you have got a UK resident family because your spouse is staying here. You've probably automatically then got available accommodation here, but you're not planning on working here. You're going to work full-time overseas, and you're not going to pick up anything else. You will have the 90-day test. That would limit you, unfortunately, to 45 days. So because you're a UK tax resident, you would be UK tax resident with those 3 or more connections if you spend 46 days or more. That's unhelpful. So it's quite restrictive. For example, though, if the family are all traveling with you and you decide to rent out your UK home, you may only have the one time, which is the being in the UK for 90 days in either previous 2 tax years, and you might even have substantive employment because you're coming back to work here occasionally. That might give you 2 ties, in which case then 90 days is your allowance. If you're not going to work here, it could be 120 days. But of course, the longer you spend here, the more likely you are to pick up ties, because it's unlikely that you'd want to spend 120 days here and not have available accommodation somewhere. Chances are you're going to pick that up. So it swings and roundabouts. So you have to be careful. It's a balancing act to a certain extent. So if you do not manage to pick up, or you do not manage to make yourself non-resident in the year you are leaving the UK. So for example, you're leaving now. You will have already been in the UK probably by the time, say you leave middle of July. Let's go for a sensible kind of time frame, because you've got kids and you want them to start school in the summer or after the summer in another country. Now, if you leave mid-July, early August, you probably are going to spend 90 days here. So even if you're going to work overseas, you will have done your 90 days here already. You will certainly have worked more than 30 days. So you're not going to be able to qualify under the automatic residency. You may, if you take a break from UK employment, be able to get around being automatically resident, but then you're going to be very, very restricted under the sufficient ties test, because you will have lived here, the family will have been here. So chances are you're not going to qualify. Under those conditions, you would need to look at whether or not you could qualify under split year treatment. And these rules are specifically designed at people who want to leave midway through the year. Now, if you're leaving the country, there are 3 possible cases that you can consider. One is to start to have full-time work overseas, or employment overseas. One is that you're accompanying a partner who's taking up full-time employment overseas. And the third is ceasing to have a home in the UK. Now, these look very simple, but they are notoriously hard to qualify for, unfortunately, just because of the way the definitions are drawn. Let's have a look at those then. So starting to work full-time overseas, you need to meet the following conditions to get that. So that you would be UK tax resident under the SRT. Well, that's obvious, because if you weren't, then we wouldn't be looking at these tests. You were UK tax resident in the previous year, including under split year. That can catch people out who are coming in and out of the UK, because if you are coming in and out and you weren't resident previously, but you would have been this year, you can't get split year. You need to be non-resident in the following year under the 3rd automatic test. And again, this catches people out. If you are going for case 1 under a split year, you need to make sure that in the 2nd year, you meet the conditions for the 3rd automatic test, i.e. 30 days or less working in the UK, and 90 days or less in the UK, and working full-time overseas. So if something goes wrong and you decide to go and work overseas, but you may be redundant or something, this can cause this test to fail. Or if you just spend too much time in the UK. So again, while it's a test that you look at each year, or in the year you're looking at, you have to look backwards, and then in this case forwards as well. You then need to meet the overseas workday criteria, which is working full-time overseas during the relevant period, which starts on the date that you kind of trigger the split. Again, there is the complicated calculation that is put together to make sure that it's nowhere near as straightforward as 35 hours a week, but effectively it's kind of 35 hours a week. You need to make sure there is no significant break from overseas work during that period. So if you are going overseas, and again, redundancy or something like that catches people out, and there's a break between employments, that can cause this test to fail. Normal holidays fine. So if you're going overseas and you say, well, I'm going to take 2 weeks off and go and visit somewhere else for a couple of weeks, that's not a significant break. That's holiday. Sick leave equally, that's not holiday. It's not a significant break then. If you are going to work in the UK once you go for a split year, you are limited to the number of days you can do that in. Now, there is a table that HMRC produce which show what those limits are, but effectively it's a pro-ratering on a monthly basis of the usual 30 days. So if you are leaving at this time of year, it's about 22 days that you could work in the UK, but not the whole 30. And then the permitted days, again, similar, it's a pro-ratering of the 90 days that you would normally have in a whole year. So again, this time of year, it's about 60 something days that you would be able to spend in the UK if you left today under split year treatment. So it is tricky to get this one, but if you are genuinely going to work full-time overseas, then case one can apply. It can also apply if you are starting your own company, for example, and you're going to be a director. There are complications over if you are not paid any salary at all. For example, you have to structure your income as dividends because of the rules of the country you're in. That can cause complications, and you need to look at that really, really carefully if you are planning to try to claim case one. Case 2 and 3 are a little bit more straightforward. Case 2, it's very, very similar to case 1, but it only applies if you are the spouse or the significant other or the civil partner or whatever. You are going with a partner and they are going to meet case 1. You can meet case 2 if you are traveling with them and you're going to be living with them. In year 2, you still have to be non-resident, but you don't have to meet the third automatic test. You need to kind of like you can be non-resident under any provisions, which means you don't have so many restrictions on your work days, but you are still limited to the number of days you can spend in the UK, again, which is prorated based on the 90 days. With case 3, it is really, really restrictive because it involves you not having a UK home. So if you are going to get rid of your UK home, you're not going to keep it here. There's no overlap between you leaving the UK and retaining your home before it's sold, for example. Then you can sometimes qualify, but you are limited to 16 days in the UK post departure. And then on top of that, either you need to spend every midnight for the next 6 months in your new country, or you need to make sure that under their local rules, you become tax resident there within 6 months, which, depending on when you've left in the year and when their tax year runs, may be doable. But for some, if their tax year doesn't start until January and you cannot become tax resident until then, that can be a problem if you leave over the summer, for example. The last condition is that you have your only home in the other country within 6 months. Again, that one's not as bad, but if you've got a holiday home somewhere else, so say you're moving to Dubai, but you've got a holiday home in Portugal, that can catch you out. So case 3 is kind of a last resort scenario, which if you can get in under case 1 or 2, it's probably going to be easier and give you a lot more flexibility. But if you're retiring, for example, and work is not an option, case 3 is the one you're looking for. So why is it important? The reason you might be looking for split year treatment is that you can split the year between the UK element and the overseas element, i.e. effectively you become non-resident earlier than you would have done. Now, that can be useful for things like your overseas income, because if you were to remain not UK tax resident for the whole of a year, then and go and work, say, in Dubai or Portugal or wherever, and you're working over there, in theory, the UK could still tax you on your salary from Portugal or Dubai or wherever, in that later part of the year, even though you're not living here. Now, the rules are designed to stop that, so that you can be in the overseas part of the year, you are not paying UK tax on overseas income. It does not stop your UK income from being taxed in that second part. So, for example, interest, once you become non-resident for a full year, you won't pay UK tax on UK interest, but in the split year and the overseas part, you will. So just be a little bit careful about that. More importantly, and something we'll come on to later, is that capital gains in the overseas part of a tax year are taxed under non-residency rules. So if you trigger a large capital gain, even if it's a UK capital gain, although not UK residential property, which always remains UK taxable, you will be taxed under non-residency rules. So if you are thinking perhaps of selling a business, when structured correctly, if it's done in the overseas part of a tax year or split tax year, you may not suffer UK capital gains tax on that, which makes this a very valuable relief, the split year treatment. However, of course, because it's so valuable, HMRC are very, very hot on when they allow and when they do not. The last thing to consider is if you have not managed to make yourself non-resident under the Statutory Residency Test, you might qualify for treaty non-residency. Now, while it's not as helpful for all taxes as becoming non-resident under local rules, it can get you out of a bit of a hole if you've made a mistake, for example, and you've spent a little bit too long in the UK. Now, this will only work if you are tax resident in at least one other jurisdiction at the same time. So, for example, you move to Cyprus and you're living in Cyprus, you're Cypriot tax resident, but you are in the UK more than your permitted days. You're in the UK for 92 days, for example. Now, depending on your circumstances, if that tips you over the allowances in Statutory Residency Test, in theory, HMRC can tax you as UK tax resident for the whole of the year. As someone who is UK tax resident, you will pay tax on your worldwide income and gains, subject to things like the FIG regime, which we're not going to talk about today. We've covered those already. But if you are resident somewhere else, then the chances are is that country will have a double tax treaty with the UK, which will set out a series of tiebreakers. It's usually in Article 2 or 4, depending on which version of the treaty is being used. And it will give you, it will go through a series of tiebreakers, which will end up with one of the countries being awarded primary taxing rights. If you are able to find the other country as the primary taxing place, you will be taxed in the UK for that year as non-resident for some purposes. So it is only relevant for income tax and capital gains tax. It does not work for inheritance tax. And again, you could end up finding that there is an argument with HMRC, and we have seen this particular cases where HMRC have disagreed with where the test would land the individual. So you need to be very careful with it. On top of that, you will lose your personal allowance. So if you have got continuing UK income, so for example from rental income, then that will not be that will not benefit from a personal allowance. So that could trigger up to a 4K tax liability just on that basis alone. So it's one of those things that's used as a last resort if all else fails. Okay, so on the assumption you have managed to make yourself non-resident by hook or by crook, you will have some UK ongoing tax obligations. So let's have a think about what those are. So usually your foreign income and gains will not be taxable in the UK, subject to anti-avoidance, which we'll come on to later. Your UK income and gains will depend on the double tax treaty with the country of your residence. So whilst there is a model articles under the OECD, so a lot of double tax treaties are similar to one another, but there are subtle differences between them. So for example, Greece and Cyprus are actually quite different from each other, yet Malta and Cyprus are the same. So it's those kind of things that you have to be thinking about because they are all slightly different. But depending on what you've got, there will be potentially a lot of the income and taxes, income and gains will be taken outside of the UK tax net. Now, if the treaty does not take the income specifically outside of the UK tax net, then what it might do is determine which country provides relief. So you're not going to pay tax in two countries. So let's look at some specific examples. So something like interest, you will probably not pay tax in the UK on that because you can disregard the income. But if you did pay tax in the UK on UK interest and you're living in Malta will give you probably relief for the tax you paid in the UK, providing that the tax treaty says, and vice versa. Rental income's the obvious one because you will always pay UK income tax on rental income on directly held UK real estate, and also with indirectly held UK residential real estate. There is always going to be a UK tax liability payable on that. So if you get income from that, you're going to pay tax in the UK, and if you're living overseas somewhere, chances are they will credit you with the tax that you are paying in the UK, rather than saying, well, we don't tax it at all. They will give you a credit for the tax paid in the UK. Because our tax rates in the UK are rather high, generally that means you probably won't pay any tax outside the UK. Now, I'm going to cover HT a little bit anyway, but what you need to think about is the fact, for an inheritance tax perspective, if you have got UK-based assets, and that includes property, it includes bank account, it includes shares, when you pass away, it doesn't matter where you are living, the UK is going to want to tax those and subject those to UK inheritance tax. The problem you have is that there are very, very few inheritance tax double tax treaties. So chances are you will not get taken out of the UK IHT net by a treaty. Now we have them with a few countries. So the obvious one is the USA. We do have a treaty with the USA. It's very complicated, and will usually though mean that that you don't end up paying tax in both places. Without the treaty, we have something called unilateral relief, and that does not give you full relief for taxes that you've paid in both countries. So you do end up paying more tax overall without that unfortunately. But most countries will have double tax treaties that certainly cover income tax and capital gains that need to be considered. So the big question, selling your business while you are not UK tax resident, are you going to have to pay CGT on it? So a lot of the tax planning we have seen people doing over the last few years are those who are going off to Dubai to go and live there, whilst potentially they gear up to sell their UK business that they've worked hard on, they've made lots of money, and they would rather not pay the capital gains tax on that. Capital gains tax, 24%, so totally understand why you may not want to necessarily pay tax on if you do not have to. Now, the answer is, will I have to pay UK CGT? It's possible that you may not. And it's one of those very, very complicated areas where we have to kind of plan well in advance. It's not the sort of thing that you can do. So well, I'm going to become non-resident today. I'm going to sell my business tomorrow. It's something you really have to gear up for and plan, because there are lots of complexities around this. But if you can make yourself not UK tax resident at the time you sell your business, then it may be possible to escape the UK capital gains tax liability. Now, it will depend very much on a lot of different things. So firstly, the nature of the company or the business. This is only going to work where we are not talking about UK real estate. If you have got a property rich company, or you are selling a company which primarily owns properties, or shares in a company which primarily owns property, you are going to pay CGT on that in the UK, whatever happens. There is no way around that. There is no clever way to pop assets, property into a company and not pay tax on it when you sell it. You'd have to look at the structuring of the deal as well. How are you being paid? What are you getting? Are you getting shares that you're going to sell later? Are you getting an earnout? All these sort of things can have an impact on whether or not CGT still becomes liable. And then, of course, the last one, the big one, is the timing. There are several areas to think about with the timing. So obviously, being not UK tax resident at the time is what you're aiming for. So that needs to be considered. You need to make sure that if you are trying to do this under split year treatment, that you understand the risks of split year treatment, and that you may or may not be granted this, and be very, very careful about the planning around that. The other big aspect of timing is if you come back to the UK after you've sold. HMRC are very, very wise to the fact that people will try to trigger income gains, whatever, while they are not within the UK tax net, and then they want to come back to the UK. If you do that, and it's usually within 5 years, you will be taxed. Okay, so this is temporary non-residency rules, effectively. So this is an anti-avoidance provision that stops people leaving the UK for short periods of time and then not paying any tax. It applies under very specific circumstances, so that you were sole UK tax resident for all or part of at least 4 out of the 7 years preceding the year of departure. Now, what does that mean? Effectively, if you've been living here all your life, you're going to get caught by this. In fact, if you've been living here, if you say 4 out of the last 7 years, so you've been in the UK for a significant amount of time, you've not just bounced through very briefly, then these rules will apply. They're also looking at where you've got a residency period that was not sole residency between 2 periods of sole residency. Okay, what does that mean? That means you come back. So if you've been UK tax resident, you cease to be UK tax resident, but then you come back again, you've met the next condition. The final condition, though, is that the total of residence periods that were not sole residents did not exceed 5 years. Okay, again, in English rather than in HMREs, it's being outside of the country. If you are outside of the country for less than 5 years, and we would usually say 5 full tax years to make sure you are covered. If you are outside the UK for less than 5 full tax years, when you come back into the UK, things you have done while you have been non-resident can be considered for UK taxes. Now, we look at various things that could be caught. So you are looking at both income tax and capital gains tax here on things that happened that were arising, accruing, or remitted during the period of temporary non-residence. Now, it doesn't affect everything. The big one is capital gains. So let's do capital gains. It doesn't affect everything, but capital gains, we are looking at UK and overseas capital gains that may arise. They will only be caught, though, if you owned the asset before you left the UK. So things you acquire and sell while you're outside the UK, even if you're gone for less than 5 years, The UK hasn't got any remit over those, unless of course it's UK property again. So if we're looking at UK real estate, you're always going to get caught on that. But if you've got something that you own, so you own shares before you left the UK, you sell them while you're overseas, and you come back within 5 years, those shares will be taxed when you return to the UK. Now, at that point, they will be taxed as if you made the disposal in the year that you returned. Now, treaty non-residency will get you out of this for this particular purpose. But what you really should be trying to do is a statutory non-residence to make sure you are fully covered, because you cannot rely on treaty residence to not be challenged by HMRC. Under these circumstances, it can also have an impact on rebasing claims. So if you become non-resident and you sell UK residential property that you've owned for a long time, you are eligible to rebase that to its 2015 base cost and only pay tax on the gain post that, which can be very useful if it's not somewhere you've been living, for example, and you've owned it a long time. If you come back to the UK, then the rebasing will disappear. It will be treated as if you were UK tax resident when you sold it. So you need to think about that. As I say, the CGT is then charged in the year of your return to the UK. In terms of income tax, the way you need to think about it is anything you've got much control over is likely to be caught. So employment is usually, so salaries are not usually caught by this. If you are getting a salary while you're overseas, you're earning that overseas, chances are you will not pay tax on it when you come back, if you come back within that period. Dividends are another matter. So if these are from a closed company, then if you pay yourself out while you're overseas and then you come back, these will fall back into the charge of UK tax on return. The old rule, so before 2025, it used to only apply where the profits had accumulated before you had left the UK. So if you were distributing post departure profits, then you'd never have a problem. Those rules changed. So from April 2025, you are caught by that. The other thing that is caught is pension lump sums and flexible drawdowns. Those can be caught because, again, if you have triggered that and you're trying to get the payment, take the payment while you're overseas and then return very quickly to the UK, then you will be caught. Loans to participators that are written off. So if you've got your own company and you have taken out significant directors' loans and those loans are written off to you whilst you're away, again, they get caught. And the last one is foreign income remitted to the UK. Now, this is a complicated one. Is if you have ever been claiming under the remittance basis rules, and you remit money to the UK during a period of temporary non-residence, those remittances will be caught when you return. Temporary non-residence is complicated anyway. But certainly, if you are trying to combine that with how the remittance basis rules work, it's one of those very knotty issues that HMRC will take great delight in having a look at, unfortunately. So, we've got plenty of time. So I'm going to chat to you now quickly about inheritance tax for non-residents, because this is quite an interesting. There's been a lot of changes over the last few years. We've done a few webinars on this, so hopefully you've heard of it. But just in case. The issue you need to think about is long-term residency. So under the old rules, if you were in the UK for 15 years or more, you were probably deemed domicile. Under the new rules, it's a 10-year period. But under the new rules, it means that someone like me, who was born here and is always going to be you can put me in Spain, I'm still British. I could live in Spain for my entire life, I'm still going to be British. But under these rules, I might actually benefit because my domicile status is no longer important. What's important is how long I've been outside the UK. Now, anyone on this call who's been living in the UK for less than 10 years, you don't really have to worry about this because you are currently not caught for UK inheritance tax on your worldwide assets. You will only need to worry about UK inheritance tax if you pass away and you own assets which are physically sited in the UK. Now, for the rest of us who have been here forever, we now have a tail. So if we leave the UK after a period of long-term residence, there will be a period of time after leaving the UK that we are still subject to UK inheritance tax if we pass away during that time. The maximum it can be is 10 years. But it could be a lot less than that. So if you've been living in the UK for between 10 and 13 years, your tail is only 3 years. If you've been living in the UK for 14 years, then it's 4 years, 15 years, it's 5 years. The longer you are then outside the UK, the more chance it is you're no longer going to pay inheritance tax on your non-UK assets. Again, this doesn't affect your UK assets. It is only non-UK assets that are affected by this. So there are very few double tax treaties, as we've already said, that cover inheritance tax. We've got the Republic of Ireland, South Africa, USA, Netherlands, Sweden, and Switzerland. They are the only double tax treaties we have that cover IHT, and they are quite complicated to kind of get around. But they could take you outside of the UK IHT net if you would otherwise be caught because you've got assets here and you're living in Switzerland, for example, or for example, if you've got a tail still at that point. The important thing to remember, though, is IHT is not just a tax on death. It can affect things like settling trusts, even offshore ones. So if you leave the UK and you have been a long-term resident and you've got a tail, if you then go ahead and settle a trust while you are still within that tail period, you could end up with a UK IHT liability, and on a trust it's like 20% of the excess over your usual allowances. So it can be quite nasty. So just something to be aware of, that if you are thinking about doing anything, because I know the US, of course, are very big on trust. So most of my clients who've gone to the US immediately want to set some sort of trust up. And we have to be very, very careful that if they've been living in the UK, that they understand that they need both UK and US advice before they actually go ahead and do that, and you understand the consequences of it. So, whistled through that. I've got 15 minutes of questions. David's sitting opposite me. I'm hoping he might have some questions for me.
Yes. So I guess firstly, does working in the UK mean being physically present in the UK?
Yes. So if you are working remotely, you're sitting on a laptop and you're sitting in Spain, then that's not working from the UK. Even if you're working for a UK company, you would need to physically be present in the UK doing some work. And that has other consequences too, because if you are sitting in the UK physically doing some work, you will continue to pay some UK tax on that under most circumstances. Now, some treaties will take you out of that. So it's only a short period of time you may get out of it, but many will not, especially if you are continuing to do work for a UK company, or if you're a director of a UK company and you find yourself in the UK for board meetings, you will almost certainly be taxed on that income. But yes, it does mean physically present in the UK.
And when you say it must not have a home, a UK home, if your UK property is rented out, would that mean the home is not available, so it could be disregarded?
Yeah, absolutely. So if your property is rented out to a third party and you are not keeping a room in it, or you've not done a deal with them that you can come and stay there when you're in the UK, then that is not a UK home anymore. It ceases to be a UK home at the point it's rented out. Now, we see lots of clients try to get around this by renting it out to family members, but that doesn't quite work if you can keep all your stuff there, unfortunately. But as long as it's to a third party and it's not available, then yes, that will work.
Under case 3, are you always limited to 16 days in the UK from then on?
Not from only for the rest of that particular tax year. So in that particular tax year, you are limited to 16 days between the point that the split occurs and the end of the tax year. But when you get to the next tax year, you'll go back to using the Statutory Residency Test, and then chances are you will probably get up to 45, 90, 120 days, depending on your circumstances. It's only for the rest of that particular tax year, which is quite heavy. If you leave in like June or something, 16 days is not a lot of time, unfortunately. But if you're leaving in, say, February, much easier.
Once you're a non-UK resident, as in a resident of the UAE, how can you extract income from post-departure profits of your personal company in a tax-efficient way, such that you get corporation tax deduction in the UK company, but no personal tax?
Interesting question. I'm quite happy to follow up on that one, but yes, I mean, you've got two options for extracting money. One depends. It depends. If you're in the UAE, chances are you're not paying any taxes on that. So you could continue to take a salary from the UK, but that will have implications if you are working in the UK. But of course, taking a salary is tax deductible. If you take dividends, you're going to pay taxes in the UK on the UK company because you're not going to get a deduction for the money that's coming as a dividend. But there's, again, it's paid over to you, but you have less of a risk of triggering any UK personal tax on a dividend. There is a fine line to walk when you're looking at a profit extraction from a UK company while you're overseas. So if that is something, though, that you want to follow up on, I'm quite happy to have a follow-up call on that to go through the specifics, because you need to make sure you get it right. There are other issues surrounding UK companies as well, which my corporate tax partners will be more than happy to chat to you about.
If I live in Malaysia, which does not tax foreign income, and I pay tax on my rented property in the UK, how do I get DT expertise on the UK tax?
Interesting question. I can only answer questions on UK taxes. We are part of an international network, so I can pop you in touch with somebody in Malaysia. But my gut reaction would be, though, that you're not going to get relief for that. The whole point of double tax relief is that you don't pay the tax twice. It's not that you don't pay any tax. So it's not designed to make sure that you pay no tax. It just means that you don't pay tax in both countries. If the Malaysian rules are that you don't pay tax there, then lucky you. But it doesn't mean that the UK still won't want their bite on it. So my guess would be you will not get relief on that, but it's worth having a chat to someone in Malaysia about that to see whether or not there's another way.
What happens if I've been working in the USA for the last 6 years and have a rental property in the UK and I'm paying tax on my income? Do I get any tax allowance if I come to see family for a few days a year?
Right. So what you're saying that you spend most of your time living in the USA, that's where you're working, but you just have to have a rental property here. Is that right? Is what I'm getting at? Okay. So I mean, this is the whole point. You are probably one of those people where the first automatic test does work. If you are spending 2 weeks a year in the UK, that's less than 16 days, and you've not been UK tax resident for the last few years, chances are you fall in under that. But it's unlikely that there is any part of the test that if you're only spending a few weeks a year here, it's unlikely that you'll be dragged into the UK tax net if you are overseas, especially because the double tax treaty would kick in at that point. But again, if I've misunderstood the question, feel free to drop me an email and I will quite happy to have a chat and talk you through it.
If you spend less than 90 days in 25-26 with only 2 ties, you will be considered non-UK resident. Will the start date of non-residency be 6th of April 2026 or the date of the actual departure?
Again, it will depend on your split year. If you have managed to engineer yourself so that you meet the conditions for the whole year, even though you didn't leave until partway through the year, then actually your non-residency will start from the 6th of April. But that it can be, again, you need to make sure you meet the conditions. Now, the big condition for this is presumably you've not been working full-time in the UK, because if you get caught by the automatically residents, then at that point we have to trigger split year because the automatic residents will drag you into the UK. If you weren't working in the UK before you left and you know you can comfortably avoid the automatic residency tests before you get to the sufficient ties, then yes, it is possible that you could though have your tax residency started, non-residency starting on the 6th of April.
Do you have any information or details on periodic changes and excluded property trusts?
Periodic charges, yeah, absolutely. Well, yes, we do. We have lots and lots of advice on that. It's not part of today's subjects that we're covering. However, David will pass on your details to me and I will come back to you for a separate chat on that, because it's a very, very complex area of taxation and it only gets more complicated every time the Chancellor stands up and opens her mouth.
I have been a tax resident in France for 7 years. I work from home in France for a UK company. Thus far, I'm still paying UK PAYE, which then gets refunded in January promptly. Should I let this continue to run, or should HMRC not be charging the PAYE first?
Okay, so if you are not UK tax resident, but you are working for a UK company, the UK company is obliged to payroll that income. We're going to actually talk about this, so you need to sign up for the webinar on the 8th of July anyway. But what happens is, yes, the UK company is obliged to payroll you for your full salary if you're working for a UK company. However, if you are not due to pay tax on that, you can enter into something called a Section 690 agreement with HMRC, Section 690. Your employer will help you to fill that in, or we can, but your employer needs to submit it, and that will allow your employer to not tax you. Now, HMRC won't automatically just not tax you. You have to apply for that non-tax status. The other option, of course, is using an NT code. If you have no UK tax liabilities and you are paying tax overseas, you can apply for an NT tax code. So instead of having a normal PAYE code applied, then you have NT, no tax, applied to the whole thing. So it depends on your circumstances, which is better, which is the right one to use. But again, if you follow up with us, I'll get David to send me your details, and I'm quite happy to contact you and have a chat to one of our team about doing that.
What is the situation between the UK and the Isle of Man?
UK and Isle of Man, very interesting. Again, I can only advise you on the UK side, but the Isle of Man is a different country. And so if you are resident you are not UK tax resident, then you could be resident in the Isle of Man and you will pay tax under the Isle of Man regime in the same way as anything else. If you want me to put you in touch with an Isle of Man advisor, I can do that. A nice gentleman called Gethin, who I work very closely with. Again, I'll get David to give me your details and I'll put you in touch.
How does the IHT tail actually work in practice in terms of HMRC's ability to enforce payment?
Love this question. I get asked this question all the time. We have absolutely no idea how they are going to enforce this. It's a very, very new piece of legislation. It's only been kicking around since April 2025. How are they ever going to trace it? I don't know. What I would say, though, is all the tax authorities talk to each other. So they all talk to each other. On top of that, we have, as I said before, the UK operates a self-assessment regime. If you do not report something, and you should report it, it is fraud. And if you commit fraud, there are nasty penalties to pay on that. So we can't encourage people to do that. But on a practical level, I have absolutely no idea how they are going to enforce this. And it was one of the first questions we asked when they announced these new rules.
Could you clarify the difference / overlapping between UK tax residents and resident status for permanent settlement in the UK?
Yeah, I can do. I mean, they are two separate things, because if you are, you can have your legal resident status, so you can have your permanent settlement status, and that's great. That's a legal thing, but your tax is going to be based on a matter of fact. So the legal side of things, and we've got an employment lawyer, an immigration lawyer, who will be on our call on the 8th of July, who will be able to talk you through this. I am not a legal person; I'm a tax person, but for tax purposes, it's done purely on facts. Do you meet the conditions under the statutory residency test that will make you tax resident? Whether you are legally resident here or not is neither here nor there. You could be legally resident in the UK, you could be legally resident somewhere else as well. And then at that point, we will look at the statutory residency test to determine whether you are tax resident here. And it's only if you are tax residency here that you need to worry about UK income taxes and capital gains tax, inheritance tax.
On the 365-day UK employment rule,
yeah.
If departure was planned just before the end of the tax year and moved before the end too, would this avoid being caught by the rule?
No, because the 365-day, you have to look back over the whole of the previous 365 days rather than the tax year to establish where you have been during that whole period. And if any day during the 365-day period falls within the UK, you are caught. So almost invariably, most people who go overseas and who have been working full-time in the UK will be caught by that initially. As I said before, that you can engineer yourself a break. If you are prepared to take a break from UK employment immediately after leaving the UK, you are able to get out of it. So there are ways around it. There are ways around it if you structure properly.
Should we do two more?
Yeah, I can do two more. I don't know what time it is. We've got time. We've got a couple of minutes. Couple of minutes.
When you mentioned loss of personal allowance on the treaty non-resident slide,
yep.
Am I right to think that if I am a British citizen living overseas, I can keep my personal allowance to offset against ongoing UK sourced income?
Not if you want to claim treaty residency or non-residency that year. So British citizens living overseas are entitled to a personal allowance, but if you claim if you use the double tax treaty to claim non-residents, then no, you will automatically lose it.
I have been away for 3 years and spent only 15 days in the UK and retired in the UAE. How long can I spend in the UK?
It will depend on your circumstances more generally, because it depends if you've still got a home here, whether or not you've got kids here, presumably not. But there will be a series of tests. And again, if David drops me your details, if your email address is on there, I will give you a call and we can talk through your circumstances and to make sure that you understand what you're allowed to do. It may be 90, it may be more days, but it will depend on what you've got going on in the UK. But it's helpful. You don't have the 90-day tie. You probably won't meet any of the automatic tests either way, because you've not been working here, but you don't have the 90-day tie. If you don't have a home here, that's helpful. If you don't have any family living here, again, that is also helpful. So, and you probably aren't working here, so you may even get up to 120 days, maybe more, but we can look at that for you. Yeah, I've got more coming.
Does having dual citizenship with the country you're you're returning to make any difference to the UK situation?
Dual citizenship can be the time when that's important, or can be important, is we're looking at the double tax treaty and we are looking at the tiebreakers, because what we look at, it's not citizenship necessarily, but it's nationality that we look at. So if the citizenship gives you nationality, that can cause one country or the other to win a tiebreaker, and if it's only if you get to that point, but generally no, because it's a legal concept rather than a tax concept.
Will the full year treatment of non-residency with this? Oh no, I think we've done that. What happens if you leave and do not come back at all and you become a nomad? Can you become liable to capital gains tax after you left the UK?
Okay, so the nomad question is an interesting one, and something a lot of people are looking at, because we live in a digital world now, and you can move around and be moving around. So it's very interesting. It's quite hard to become nomadic, become tax resident nowhere, and the biggest risk is that you are not protected by any tax treaty. If you leave the UK and you go and live in Spain, you are protected by the Spanish double tax treaty, which means you get a certain amount of allowances. If you go to Portugal, blah blah blah. If you are a nomad, you are not protected by any of the treaties. So any country you spend a bit of time in, you could automatically be subject to tax in that country, even if you're only there for a few days, including the UK. The capital gains tax question is an interesting one. Now, in theory, if you're non-resident, then it should be possible not to pay tax on non-UK sites as property capital gains. It should be possible to do that, but I would want to look at very, very carefully your circumstances to make sure you understand what is going on in your world, because it's not an easy position to be in, to have no residency status anyway.
And
last one?
Yeah, last one.
One more question.
This is, I guess, a positive one.
Go for it.
I want to sell an SPV,
yep,
leave the country and be advised accordingly. Who should I organise a meeting with to be advised?
You can organise a meeting with me. If you email David your details, or David's probably got your details, I will drop you an email. We'll have a chat and then see how we can take it from there. And it will be either myself and probably one of my colleagues from our corporate tax team. So we have everybody here can help. I'm more than willing to help and see what we can do. Well, I hope you found that useful. If there are any more questions, please do ping those over. We will get back to you as soon as we can. There is a poll that's gone around that's asked for individuals if you'd like an individual follow-up. David will send those through to me and I will get back to people over the next few days/weeks. And yeah, if there's anything else I can help with, do let us know. Enjoy the rest of your day. Please sign up for the remainder of our series. And I'll look forward to seeing you all, speaking to people as and when. Take care. Have a nice day.